Hello, everyone. Today, we're going to talk about a possible acquisition of Garmin by Alphabet. Next slide, please. We are the Synergy Advisory Group, and we are a premier mergers and acquisition consultancy. We have 20 years of experience across various industries. Our mission is to empower businesses to achieve their strategic goals. Next slide, please. This is the team that will be briefing you today on the valuation of Garmin and why this is a good acquisition for Alphabet. Next slide, please. This meeting is designed to present a comprehensive merger and acquisition proposal recommending that Alphabet acquires Garmin. Next slide, please. The audience present today includes Google's executive leadership team, Garmin's board of directors, Synergy Advisory's group team, as well as any key stakeholders and investors that will be affected by this acquisition. Next slide, please. Alphabet is Google's parent company and is set to acquire Garmin, who's a global leader in GPS technology and outdoor devices. This strategic acquisition would align with Alphabet's broader goals of expanding its technology ecosystem. Next slide, please. The strategic rationale behind this acquisition, we're going to focus on market expansion as Garmin has a strong presence in the outdoors market, particularly in niche areas, and data utilization. Garmin has an extensive data from health and location tracking that would bolster Alphabet's data analytic capabilities. Next slide, please. We are going to see some industry changes, such as technological advancements. As the technology industry is rapidly evolving, acquiring Garmin would allow Alphabet to integrate these technologies more seamlessly, as well as the regulatory environment, as there's going to be more regulatory changes around data privacy and security. Next slide, please. There will be some diversification shown, such as the global reach, as Garmin has a strong international presence in markets such as outdoor, aviation, and automotive, as well as customer and service diversification. Garmin has a focus on the health and fitness wearables, which would complement Alphabet's existing services. Next slide, please.
And looking at potential reasons for Garmin's availability, Garmin really faces intense competition from larger companies like Apple, especially in the smartwatch category. And Garmin could be looking to partner with a larger company such as Alphabet to grow. Next slide, please.
So based on those analysis, here we have created a SWOT analysis of this potential acquisition. So some of the strengths is the demand is consistently increasing, especially not just in the health and fitness, but also in navigation. And based on this, there will be a lot of potential for technological edge when you think about connecting within the Google's current ecosystem. Some of the weaknesses that we predict is basically there might be some integration issues as cultures can potentially collide. However, with the past experience of Alphabet, that could be eliminated. There are some product overlaps. However, there will be affecting different market segments, so that could be avoided as well. When it comes down to opportunities, there are opportunities across all different industries, including health, fitness, automotive, innovation, and also expansion of the reach globally. Some of the threats we perceive is that the competition is consistently increasing and market is thought to be saturated. However, the constant rise in demand will potentially still give an edge to this acquisition.
Thank you. With all this background information, we will make our comprehensive analysis. We started by a WACC, which is very important for understanding the company's value. The current risk-free rate is 0.9%, which we got from the 10-year treasury rate of Switzerland. Garmin's interest expense is 0, and then the cost of debt is 0. So also the latest tax return calculation was a negative number. We got set it to 0. Next slide. Using a beta of 1 and a market risk premium of 6%, we calculated the cost of equity at 6.99%, 92%. Since Garmin has not interest debt, the cost of debt and the tax rate were set to 0. Adding all these numbers, we found the WACC to be 6.89%. This number supports our future valuation model, showing the return expected by investors. Our projections for Garmin's valuation covers 5 years. We looked at important numbers like property, plant, equipment, projected revenue, and that we use also our WACC that we use of our previous calculation. All those assumptions we will use in the for the next valuation. Please, next slide. We also have some projection of property plan, equipment growth, networking capital needs, and sales for the next 5 years. All those numbers supports this table that shows the free cash flows for 5 years, considering changes in net working capital, capex, and terminal value. By using the discount factor, we calculated that the present value of free cash flows and terminal value is 25 billion. This number is crucial for understanding Garmin's true value. Next slide. To find the equity value, we subtracted the total debt from the enterprise value, getting by 24 billion. Dividing this by the numbers of current shares, we get an equity value per share of 127. This number is important because it acts as a benchmark compared to the current share price, which is 168. It shows that there might be potential investment opportunities as the market price is higher than our calculated value. This gap could mean that the stock is overvalued or that investors expect high future growth. In summary, overvaluation can make the acquisition more expensive and risky, but it might be also a positive because of the future growth and investor confidence. Next slide. Lastly, our sensitivity analysis shows how changing the WACC and growth rate affects Garmin valuation. This table shows the strength of our model and let us look at different scenarios, ensuring we understand potential risk and returns. In conclusion, our detailed valuation and careful analysis of Garmin show it is financially strong and strategically beneficial. With a solid WACC calculation, detailed projections, we think that Garmin is financially strong, and we are confident that Garmin is a valuable addition ready for future growth and success. Next slide.
Looking at perceived synergies is sort of two buckets, horizontal synergies and vertical synergies. Horizontal synergies, we see our product enhancement and market expansion, which would ultimately benefit both companies in a combined merger. Vertical synergies include supply chain optimization, data integration. Next slide, please. In looking at the financial implications of these sorts of synergies, we could see projected sales to grow from 5.4 billion to 6.6 billion by 2028, EBIT improvement from 1.1 billion to 1.4 billion by 2028, and strengthening competitive position will allow kind of an ultimately high net cash position post-acquisition at $92 billion. Next slide. Looking at sort of a couple different valuation methods, we examined a discounted cash flow valuation wherein we took the WACC and applied it to our cash flow, and we got a range of $27.5 billion to $35.6 billion, which is sort of in line with the valuation that Zola was looking at earlier. And then we examined a lot of different tech companies and a comparable trading method and got a $10.8 to $16.3 billion sort of range in the comparable companies valuation. Next slide, please.
So in order to go through with this financing of acquisition financing, there are different options. There's cash financing, there's also debt financing, or we can just do equity-based financing, or we can use the combination of both stock, cash, and debt. When it comes down to Alphabet acquiring Garmin, we're predicting that Garmin acquisition would the cost would be just a 20% premium, around $37 billion, and this could be done via various different options. However, our proposed financing for this deal is the combination method of between cash, debt, and equity. Do believe that giving a $19 billion cash, because there is a $110 billion cash reserve for Alphabet, doing $19 billion cash in addition to $2.7 billion into debt. And rest could be done in the equity form. This will allow post-acquisition for Alphabet to have just around $32.5 billion in debt, and or just close to $92 billion still remaining as a net cash position. Now, how would this look in combination analysis is here what you see on the left is the individual analysis of Garmin and Google as a standalone financial data. On the right side is the merger, the post-merger analysis at around 10, 20, or 30% premium on top of what Garmin is currently worth. So when you look at this combination analysis, what's notable to see here is that the pro forma EPS of post-merger, the EPS is set to be positive over the buyer, which is Alphabet buyer's EPS, projected EPS in 25 and 26, which makes this deal accretive deal at not only 10%, but 20 and 30%. That means that without any synergy, even though we do predict that there will be synergy, if there is no synergy, this acquisition would be accretive regardless of any perceived synergies. Now, we had come up with this very tailored financing approach for Alphabet to acquire Garmin is because one of the requests that we had received from Mr. Pichai and the CEO and the CFO is not to exceed the debt to cap ratio of more than 10%. And since there is enough cash available in bank, we're able to dispense $19 billion in cash and rest in equity and debt deal, which allows Alphabet to remain in their positive top of the line credit rating, so that in future they're able to have more cash to take various different risks beyond the acquisition of Garmin.
Thank you all for listening to our pitch about Alphabet acquiring Garmin. Our bottom line recommendation is for Alphabet to go ahead and acquire Garmin with the acquisition at 20% premium. Thank you for your time today.